This is a Your Farm Business podcast with Mike Krause of P2P Agri. Welcome back to another episode of the Your Farm Business podcast. My name is Tom and I'm your host for this episode today. And we're chatting with Mike Krause, the CEO and founder of P2P Agri. Good morning, Mike.
G'day, Tom. Good to see you again.
You too, mate. Great to be back in the chair and on the mic having a chat. And today we're talking about banking, the relationship between banks and between farms, and especially that lending process and sort of the relationship between the two. So you've got a fair bit of knowledge on this topic, Mike, because you've had a little bit to do with it over the years. So for the listeners and the viewers watching this one today, can you just share a bit of your background into your relationship between banks and farms?
Yeah, sure, Tom. I guess I might say from the outset, I haven't been a lender in a bank, so I haven't walked onto someone's farm and say, right, let's have an assessment. But in my career, I've worked for 4 years for a bank in South Australia as their economist. So I used to relate to people who in the bank were lending to farmers. So I understand the processes they go through, and also from a bank's perspective, what motivates them in lending to farmers. And after that, after I left the bank, I've been a consultant to farmers. So if they want to buy the next door neighbour out or borrow some more money, they'll come to me to help them put their numbers together to talk to the bank to secure their lending. So in doing that, I've had a vast experience in working with different lenders and different farmers in that situation.
So in a general sense then, Mike, what motivates a bank to lend to farmers when farmers go to approach them?
This is a really key question, Tom, because as farmers, we always assume the banks have our best interest in their hands. Mm-hmm. So if the banks analysed our numbers and said, yeah, Tom, you can go and buy the next door neighbour, we're going to lend you that $3 million that you're after. Some farmers say, well, the bank thinks it's a good idea. Must be a good idea that I can go and borrow this money. But I guess from an outsider, don't let the banker be your final decision maker, because effectively you're the person that's agreeing to that $3 million loan that you're about to take out, and it's your responsibility to pay it back. So you've got to make sure that that decision is a really good one for your business, and it's going to help plot the path going forward to help you continue to grow the business, grow the wealth of the business, and grow the profitability. The bank's motivation is very different. The bank's motivation is to their shareholders. So they've got to make money as bankers, lend money out and take money in. In fact, if you think about a banker's business, it's a bit like a water pipe where water represents money. The quicker the water goes through their pipe, they're just taking a little bit of margin out. So they're bringing depositors' money in and they're lending money out. So water's going through the pipe. The quicker that goes through, the more margins they make, the better profits they have for their bank and bank shareholders. So their motivation is to make sure that water's flowing well and the margins are healthy so that they can keep their profits. So when banks lend to farmers, their motivation is to make sure, yes, you're a secure person to lend to, yes, and the likelihood of me being repaid by you is very high, so let's do a deal. Do they worry about whether Tom's ultra profitable or just profitable? Doesn't really matter to them. They just want to make sure they can get their money back over the longer term.
Okay, so that sounds like it'd be quite an equation for them to work out. How do they juggle the opportunity and the risk when a farmer comes to them and says, hey, look, this is what I'm looking at doing? There's obviously a lot of risk involved, but also great opportunity. So how do they look at that and what are they looking for?
That's a really good question too, Tom. And sometimes we think, it's just a black and white thing, They just pull the numbers out of Tom's accounts and recrunch them and look at them, and yes, they pull it out of the computer and it says yes or no. There are some grey areas in that area, and that's where farmers should understand they can influence those grey areas. There's three things really that bank is looking for when they come to lend money to a farm. First of all, they'll be looking at the balance sheet. So that's where we look at all the assets that the farmer owns against any loans that they currently have outstanding. And they're saying, right, is there capacity in the balance sheet? Because what they want to do is secure, they call it securing the loan against the asset. So you can mortgage the asset. So Tom owns some land, wants to borrow this $3 million. If I mortgage against the land, and hopefully the land is worth, say, $10 million. So if all the wheels fall off Tom's business, then we know we could sell the land for $10 million and we've got capacity to get our $3 million back. So security is number one. I know banks say, oh, look, we lend on cash flow. But really, if the security isn't there, if the ability for that lump sum not to come back to the bank is not there, then they won't be that interested in lending to you. The second one is what is our ability as farmers to repay. And that's why they get so focused on your cash flow. They say, righto, Tom wants to buy this new land and he wants to borrow $3 million. That means his loan repayments will go up to X amount of money a week or a fortnight or a month or a year, depending on what we negotiate with them. They'll want to have a look at adding the new land, adding the new debt, looking at the extra income that's going in, the extra expenses going out. So if we're buying this new land, we might have to borrow more for seasonal finance, for fertilizer, for seed, for chemicals, that sort of thing. So make sure that all works. Do the cash flow, and then we can test the cash flow. What happens if we had a drought? Or what happens if the season wasn't as good? How safe is that cash flow where the bank can still get at least interest payments coming back from the lending they're giving you? So they're the two things that are probably black and white. You know, we can't invent too many numbers there and pull the wool over their eyes. The third one is the key one where farmers can present their business to the bank. So Tom's going on, wants to borrow this $3 million. Yes, if I go with all my homework, I've done the balance sheet. Yes, I've done the cash flow. Yes, I'm demonstrating to the bank that I understand their risk of lending to me. I'm already providing this information to them. Plus, I'm going to tell the bank what I'm going to do with this new land. In fact, I'm probably going to tell the bank in 5 years' time, this is where I'd like to be. So I know where I'm heading, even though I've got quite a lot of risk and uncertainty. You know, we don't know what interest rates are going to do. We don't know what the season's going to do. We don't know what commodity prices are going to do. But with all this risk and uncertainty, we understand how we're going to manage our business, not only for our own profits, but also to ensure the bank gets their loan repayments coming through. So they're the three things that the bank's really looking for. First of all, your balance sheet. Secondly, your ability to repay. And thirdly, they're judging how good a manager Tom is, because there's a bit of a rating in there. And if Tom's presented himself well, the bank's two things is they're likely to get confidence that Tom's going to say what he's going to do and repay them. But secondly, they're going to rate the risk of lending to Tom at a better level because they know Tom's on top of his business and managing it as well as he can for himself, as well as on behalf of the bank, because they're really now becoming a partner with you in running your business.
Yes. Okay. So it's quite in depth. There's a lot of cogs turning in this big machine of the lending cycle. From a seasonal point of view on the farm, because cash flow can be irregular and it can be stacked towards one section of the year only, how does the bank approach seasonal lending in that sense? And I suppose to how that plays in with things like fertilizer and cropping, where there might be a big outlay at a certain point in time, versus trying to get lending to buy more land or buy the next door neighbour. I mean, they're slightly different boats, I think, those two things. So how would they approach that?
Yeah, well, look, they do approach them differently, and it's slightly different risk to them is to lending you seasonal finance as opposed to lending you that $3 million for the land that you wanted to buy. Seasonal finance, again, it comes back, they want to know your cash flow so that they want to know in their bank how much money they've got to have available for Tom when his cash flow is peaked up. So that's likely to be in a mixed farming situation. That'll be late April heading into June, July, when everyone's maxed out their seasonal loans for the fertiliser they need, the seed and the chemicals they need. And then they've got to wait out until harvest starts to come. So they'll look at your cash flow. And because that's a bit more unpredictable, Tom doesn't know whether he's coming into an average season now or it's going to be a good season or a poor season. He gets a bit of an idea of what he's going to spend, but if the season turns really well and he's got a lot of subsoil moisture, he wants to put a bit more nitrogen on, he might want to go back to the bank and say, can I buy some more nitrogen? So may extend his overdraft that way. So the banks know that that's quite variable, and Tom's ability to pay all that back at the end of the year is really dependent on his harvest or the wool clip or the cattle sales or whatever the case might be. So that element is riskier for the bank, and so they generally price that a bit higher. So what I mean by that is that the interest that they're charging you will have a more of a premium of risk in it, and so you're probably paying a bit higher. Whereas if they're lending to you for your $3 million land purchase, well, they'll know that that's a fixed amount. You're buying that land for X amount of dollars. That's what you need to borrow for it, and your loan repayments are set. Generally, since the Banking Royal Commission, banks would tend to say, righto, Tom, this is a 20-year loan. We've got to pay interest and principal at the same time. So that'll be a regular payment, and it's a bit more predictable for the bank. Plus, they've secured both of those loans probably against your land anyway, your mortgage. So the land loan is a little bit more secure for them, and so the risk is a little bit down. But more recent times, some banks have encouraged farmers to go what they call a line of credit, where they'll add the seasonal loan and the land loan in the one facility. So no longer do you repay your overdraft to zero every year. You'll pay a little bit back each year. And if you're in that facility, or farmers are in that because it's become more popular with banks, just make sure as a farmer you're controlling your financial management and recording a lot more effectively. Because it's like giving a farmer a big Visa card, and we can always max that out.
Yes.
And we don't want to be in that situation.
No, not at all. And so, since you've been doing this for a while, Mike, are there any sort of common mistakes that farmers make when they approach a bank for finance? And it might even be before they approach the bank, just in their mindset about how they approach that idea of lending and getting finance in the first place?
Yeah, well, one of those mindsets that farmers have is it's a bit like their accountant. Once you've got a relationship with the bank, is it hard to leave the bank? My father banked with this bank and his father banked with this bank, and I'm getting a bit put off by, having to talk to a new branch manager every 6 months, and I'm not developing a relationship with them, and they don't really know my operation, and the fees and the interest that I'm being charged are going up. Is it hard to leave a bank? Look, the first bank you leave is always the hardest. But once you've done it, then it can be done. And I know some farmers have a bit of a policy in their farm to say, look, I want to keep the banks honest. Every 5 years, I'm going to put my business up and go out and get a quote from Bank A, Bank B, Bank C, Bank D, and see who can come back and give me the best deal. Because we don't want to forget that the big four banks are competing with each other. And one thing that farmers don't probably think about is that banks would rather keep Tom as a client than to lose him. Because if they lost Tom, they have to then go invest a lot of marketing and sales to try and replace him. So the last thing the bank wants to do is lose a client. So if you're not that happy with what the arrangement is going, go through that process of looking at what the other banks will offer you. You can always go back to the original bank and say, hang on, this is the offer. Can you match it? They might match it and save the issue of changing things over. But there is a bit of power in the farmer's pocket that they can utilise if they want to. But I will say, don't go to your bank and say, I'm going to go shop my business around, and you don't do it. Then the bank says, oh, okay, Tom's he's not going to follow through, so perhaps I can edge these interest rates up a little bit because that's how I make my profits. And if I can get away with it, I will. So there's a few little myths in there, but it's also good to understand how your bank thinks of your business. And there's a few ratios in there that would be good to understand so that when you're going and talking to the bank, they can say, oh, Tom understands the risk that we have as a bank lending to him. He's put these strategies in place to help manage that. He'll go to the top of the tree of the people that we want to lend to.
Yeah, okay. All right. So they appreciate that due diligence that farmers take beforehand to, ensure everything's going to check out.
Exactly. And that due diligence goes a long way. And I don't think it's that common in farming that farmers do their due diligence with them as well as they perhaps should.
Okay. All right. So a couple of common mistakes that might be very common. So when they do end up going to the bank, what kind of documents do they need to show? What helps them actually get the loan over the line, if you will?
Okay, probably it wouldn't hurt to do a business plan, Tom, which a business plan really tells the bank why you're farming, what the vision is for the farm, how you're going to achieve that. So, is Tom going to be the best breeder of cattle in his district or the best breeder of merinos or the best crop producer? So how you're going to do that and some of the strengths and weaknesses of the business, they'll definitely want to see updated cash flows. So if farmers are doing planned cash flows and doing actuals, that demonstrates very clearly to the bank that you're staying on top of your business because, as we know, farms do change from year to year, given seasonal and market shifts that are happening. So you're staying on top of it as these different changes come through, but also give them an updated balance sheet where you feel your land values have been, where your machinery values and livestock values are, where your current lending sits. So when you're doing a review, they can see clearly that you are on a path to success and you're monitoring that path to success. And part of that is giving them confidence that you're in control of your business and you know where you're going and that they're a partner with you in helping to do that. And you're giving them information just to make sure they feel secure in the loan repayments that they'll be coming that way. So do a business plan, make sure you've done the cash flow and do your balance sheet and present that to the bank. If you're really keen, you could do some of the ratios that they look at, like the percentage of variable costs that you're spending out of your gross income. Interest rate cover is another ratio there that you could get done.
So do you find, Mike, that a lot of farmers, when it comes to banking, they just set and forget? So once they get that initial loan, the initial overdraft, as long as they're sort of getting that back and keeping that steady year on year, allowing for the odd fluctuation or drought or mishaps here or there, what would you say to people who do that, who they kind of just set and forget? Are they missing out on potentially something better by not doing just a little bit more?
Look, they are. There's a movement in the interest rates that you pay or farmers pay banks. I'm sort of off the top of my head, there's about a 2% interest movement in that. That comes back to how the banks are judging you as a manager and how you're managing that risk for them. So if you're doing this extra all the time, keeping on top of their perception of you as manager, then you'll be going well. But if you set and forget, that's one of the worst things you can do, Tom. Mainly because, these banks are here to make profits. So if they can get away with charging you a little bit of extra interest, they will. What's to stop them? But having said that, banks are quite conservative in the way that they lend money to you. And I did go on to a bank had asked, no, it wasn't a bank, a client had asked me to come and visit them to look at their financial situation. And when I added up the numbers and I saw their equity had dropped to 17%. Now, banks like to see you at 60 or 70% above. So these guys were at 17%. And I'm thinking, oh no, knowing what banks are, I'm thinking, no, looking over my shoulder, is the bank manager behind me is about to come and take this farmer's keys off him. And I got back to my office and I rang the bank and I said, I know that these guys aren't travelling too well, but do you know how bad they're travelling? Oh, yeah, we've got them in the non-performing loan section of the bank. And I'm thinking, well, that's not a good thing. What are you doing to help them? Oh, well, they're at 17% equity. We know that. We know that once they sell up, we're going to get all our money back. But what the farmer didn't appreciate is that land values only had to shift 10% down and he had no assets in his farm. So the bank would get all their money back, but he'd walk away almost destitute. So if you set and forget and don't continue to keep monitoring the good financial performance and where you should be, you can go down into a deep hole of suddenly not making your repayments, interest compounding, and you'll be in a position where you could lose your keys to the farm. So that's probably the worst case scenario, but I have seen that in my career.
Yeah, okay. All right, good word of warning. And how does things like fluctuating commodity prices, the rise of carbon farming, the advent of AI and technology, how do banks treat these sorts of things that come and go? So trending things, I guess. How do they treat that when it comes to lending and loaning? Because lots of media pieces will really promote one or two of these things when they come out. So we've heard a lot about carbon farming. We've heard a lot about technology. And so that sometimes influences the banks.
Sure, yeah. If they're saying that you're adopting technology and adopting it efficiently to improve your performance, that could only augur well for you as a potential borrower or increasing your borrowings to the bank. They'd like to see that you're on top of your management game and you're continuing to adopt technologies that help, I guess, improve your security of repaying their loans. Yes, there has been trends where banks say, look, we've got green loans, so if you've, doing your right bit by carbon and those sort of things. But sometimes they're a bit of a fad. They come and go, and I've seen that. It's only if they're really embedded in the infrastructure of the industry, like governments have said, right, Tom, you've got to tell me what your carbon rate is, and we've got to prove that you're improving that over the years, otherwise we're going to put penalties on you. Well, that hasn't happened in Australia. The banks are still competitive, so even though they say, look, we'll give you a green loan, that doesn't stop you to go and talk to another bank and see what they can do. And they might match those green loans. So they'll come and go. You mentioned AI. That is such a huge moving target at the moment. Things are changing so quickly. So if we had this discussion 2 weeks ago, I'd say, yes, banks are starting to use AI to crunch the numbers and give them more confidence that the numbers are telling them the correct picture before they loan. But now what's happened in the last week is they're inventing different agents. So it's like two people talking to each other. These AI agents can talk to each other and do combined processes together that I don't know. We might only be a year away where you ring up a bank and you don't know whether you're talking to your local branch manager or you're talking to an AI bot who's asking you questions to get information out of you and therefore processing it, giving it back. The world is changing quicker than we've probably ever realised it could change at the moment. And I know one thing banks are doing, and they've done this for the last 20 years, is that the major cost they have to their business is employees and staff. So if AI are coming in to replace what staff can do and employees used to do, and it's half the prices of employing them, well, guess what the banks will be using? They're going to be going down that track as well. So I guess watch this space. The fundamentals that we've talked about in this podcast won't change. As farmers, you're probably protected not being gobbled up by AI. You've still got to produce grain. People still have to eat tomatoes or bread or milk and AI isn't going to produce that overnight. So you're in a good position there. But some of these people you'll be dealing with, like banks and accountants and advisors, will be continuing to use this phenomena of AI, which is just, I don't know, it's just amazing the stories I'm hearing at the moment, what it's doing.
Yeah, it is. It's changing very, very fast. So, given everything we've spoken about in this episode, Mike, what would you tell a farmer? What advice would you give a farmer who wants to be bank ready or who wants to be able to approach the bank with confidence?
Look, I like we were talking about before, when you want to go to the bank, have a business plan, have your cash flow done, have your balance sheet done, go and talk with them so that you're knowing your finances and you even can do more homework and know how some of those risks might have changed to the bank, and you can discuss that with the bank. That's really high level management. But if people are not quite up to that speed at the moment, well, I do things like, educate yourself. So we've actually created a course through Tocal Ag College, which is in the Hunter Valley, which is all online, which helps educate farmers into improved financial literacy and help develop these things like cash flows and balance sheets and business plans and things like that. And that can be all done online. So we're using cloud-based software. We're using Zoom or Teams to communicate. You don't have to leave your office to do it. So look at opportunities where you can educate yourself. Other farmers could use consultants to bring themselves up to speed. But I will say, though, banks will want to know if they're lending to Tom, that Tom has those skills, not his consultant, because it's Tom who will be repaying that $3 million back, not his consultant. So there's still got to be an element of business acumen that farmers need to know, and it's really beneficial to know. If they don't have that, seek to see how you can find that. Jump on that course I've just talked about, or there's other opportunities to get that education.
Okay, that's really, really good advice. Before we wrap it up today, Mike, are there any common myths that you'd like to debunk, or anything that you hear quite commonly that makes you shake your head and just go, no, it's not how that works?
Look, I think there's a couple of common myths there. One I probably mentioned earlier. As a farmer and a business decision maker, if the bank says, yes, Tom, that $3 million you can borrow, don't say, because the bank said it, I could borrow it, it must be a good decision. That's one of the myths. You've got to sit back, be the master of your own business and work out whether that $3 million you're about to borrow is going to make you more money for you and not just the bank. And so you've got to make sure that that is a profitable thing, that you're not putting yourself in jeopardy where loan repayments won't be able to match. Even if we have a poor season, if we can't get the loan repayments back, you might be digging yourself in a bigger hole. So that's one of the myths. You've got to be in control of your decisions because it's your legal commitment to repay it, not the bank. So that's one myth. And the other myth, I guess, is that, yes, you can change banks. You're not shackled to the bank that you have, but it's easier to change banks when you're in a financially strong position than in a financially poor position. So take that opportunity when it arises.
Yeah, good advice. And you mentioned about the online course a bit earlier, Mike. So where can people go to find out more information about that?
Okay, if they go to use their browser like Google or Edge or Firefox, just put in the search bar, Plan to Profit, Tocal, and that would take them to a website where they can investigate how the courses run and what learning outcomes you're going to get and those sort of things. Or look, they can come directly to us at P2P Agri. You also could Google that. That'll take you to our website and give you contact details. And we are training farmers right around Australia one-on-one, bespoke, so we can meet the farmers' learning needs at whatever level of learning they've currently got. So they can use those two approaches.
and at whatever time schedule they've got as well. So if they want to do something all close together in a week when it's too hot to do anything else, they can do that. It's not you're not going to miss out if you miss the 9 o'clock Monday morning window.
Exactly. So if you come directly to us, we sort of bespoke the learning to what your work requirements are, what your other responsibilities are. If you go to Tocal, though, it's more rigid. It's like a fortnightly rhythm where there is homework you need to do, and it does keep you honest. But ironically, we've run it through seeding time, we've run it through harvest time, and we still get really good completion rates from our students. So obviously you must be engaged enough so farmers can really... But we've had some wonderful feedback from there, Tom. Farmers are telling us they'd rather do the learning that way than the old traditional go to the CWA hall. And also they've walked away from the course learning what they hoped to have learnt prior to enrolling. And so again, do the formal learning or come to us informally and we'll help you as a team.
Fantastic. And do you have any other closing comments before we wrap up this episode, Mike?
No, look, treat banks as your friend, not as your enemy. They are a partner to you, so keep your communications open and free with them. And yes, you'll have to live with the way that they'll change managers quite a bit, but that doesn't mean you don't communicate with them. But we do need lending to continue to grow our business, and there is good lending and bad lending. I'd really encourage you to continue to use the good lending.
Yes, very, very good. And Mike, this episode has all been about the lending process, about the relationship between the farmer and the banks. I just wanted to end on a quick note of what the next episode's going to be, because that ties in quite closely with this one. And that's going to be talking about tax and the accountant. So you've also got a bit of history in those areas and relationships between accountants and farmers.
Yeah, I'm familiar with that, Tom, with the amount of accountants I've worked with and farmers. So I want to talk about what really motivates your accountant and how to get the most out of your accountant. It's a bit like what we've just done, what motivates your banker and how to get the most out of your bank.
Yeah, great. Well, I look forward to chatting with you on the next one. Thanks so much for your time.
Thanks, Tom. Catch you soon.
Thanks for listening to the Your Farm Business podcast. For more information or to get in contact with Mike, simply search for p2pagri.com.au.